want to talk about is there's been a lot of talk in the media recently about the possibility of recession. And so we have another illustration up here that shows how the stock market typically performs before, during, and after recessions. And it's a little bit of a busy chart, so we don't, we're not going to go super far into it, but what we particularly want to pay attention to is that on average, stocks perform worse previous to the recession than during the recession. And then in the 2 years following the recession, returns are positive 82% of the time.
Yeah.
And it gets higher,
Yeah, if you go out on this chart, show them the column of 12 months after the recession, right there. The average return of the S&P 500 12 months after recession was 16%. It was positive 91% of the time. And then 2 years after recession, the average return of the stock market was 20% per year, and it was positive 82% of the time. So recession and the threat of recession is not going to collapse the stock market. The stock market's going to be fine, and it's a great place to be. And also what they're calling a recession are usually relatively short-lived.
You can see that in this length column over here. Most of them are under a year. They're usually, on average, probably 6 months.
Yeah, or
between
less.
The average of all these.
Right.
And yes, the returns are negative previous to and during, but they're very short-lived. And then right after, 6 months to a year to 2 years after, the returns are way higher than the negative returns that were experienced during.
Right.
So the stock market can recover from recessions, and they're short-lived. And so if that's something that happens, it's going to be okay for the stock market.
Right.